Hello, everyone. Welcome to session 5. In this session, we're going to talk about inventory and all methods to calculate inventory, cost of goods sold, and revenue. So, there are different systems uh, for inventory. So, the first one is perpetual, and the second is periodic. In perpetual inventory system, we have actually an inventory system in which the quantity and cost of each inventory item is maintained. So the moment you sell one item from your inventory, it is recorded in your inventory system. Like when you go to Walmart or Canadian Tire, they keep track of their inventory the moment they sell one item. But in periodic, the records are not maintained all the time, and they actually have some calculations by hand and compare it with their system, and the ending inventory is compared with what they have counted, and see what is the difference and how actually this difference happens. So this periodic system tends to be for luxury or high-end items, but perpetual inventory systems tends to be for everyday items. The other thing in this chapter is discounts. For example, in this actually slide, you can see that we have 5, 15, and 30. We read it as 515 net 30, which means 5% discount if paid within 15 days. Otherwise, the invoice price is due in 30 days. So if you pay within 15 days, you can use 5% discount. Otherwise, if actually your payment passes 15 days, you need to pay the full amount in 30 days. And the other important point in this chapter is the freight cost. So we have FOB shipping point or free on board shipping point and FOB destination. What is the difference? In FOB or free on board shipping point, the shipping point is actually happens and the ownership and cost is for buyers. So the moment the company sends the item for the buyer from the shipping point, the ownership and cost is for buyer. Whatever happens to actually the item, the actual responsibility is on the buyer. But in free on board destination, the ownership and cost is for seller till the item gets to the destination. And from that point, the ownership and cost is for buyer. So it's actually determined in your contract with the seller. The most important part of the chapter is inventory costing methods. We have three methods: specific identification cost, weighted average cost, and first in, first out or FIFO cost. We actually emphasize on the weighted average cost and the FIFO. In a specific identification cost, we actually use it for businesses with unique inventory items such as automobiles, antique furniture, jewelries, real estate, art, and etc. Cost of particular inventory unit can be determined. But in FIFO and weighted average cost, what we do is the cost of first item purchased is cost of the first item sold. So the first item comes to your inventory, and when you want to make a sell, you use the item uh, which is actually which came sooner to your inventory. So, for example, If in this picture we bought this item, the third item first, and then the second item, and then the first item, then we want to sell here. It shows an output from inventory. We need to first actually sell the third item and then the second item and then the first item because our third item came to our inventory sooner than the second and first item. But for weighted average cost, you need to take a weighted average of the cost of items and calculate the cost of item you want to sell. For example, if the actually sum of uh, cost of items bought is $36, you need to take a weighted average. So 36 multiplied by 3 gives you 12. So $12 is calculated to actually is used to calculate cost of goods sold of the item you want to sell. You can see it in the example better. So you actually uploaded and submitted P543A question. So I want to work on it. In this question, you can see that during March 20, it's first month of operations, Corporation reported the following transactions. So we have a couple of transactions relating to purchase and sell, selling of items from inventory, collecting cash, and etc. The company uses the perpetual inventory method and pays 40% income tax. They estimate a return rate of 2% of sales, which means from our actually sales, we expect 2% of sales is returned to company. So we consider it. And the income tax is 40%. We use this 40% in the statement of income to calculate the amount of tax we need to pay. We are required to do some actually steps to solve the question. So first step is preparing journal entries to report the transactions for the month of March, assuming the company uses the FIFO inventory method. Explanations are not required. Okay, our first transaction is here on March 1st. The company purchased 15,000 units on account for 10 each. Okay, we purchased on account, so it increases our accounts payable for $150,000. Why $150,000? Because the number of units is 15,000 units and the cost of each is $10. So 10 multiplied by 15,000 is $150,000. And we purchased some items for inventory, so it increases our inventory. So we debit inventory for $150,000. The second transaction is here. The company purchased 20,000 units on account for $11 each. So again, like the actually previous transaction, our inventory goes up for $220,000, and because our purchase was on account, it's $220,000. The most important part of it is actually dates of purchase. Our first transaction happened on March 1st, and the second transaction or purchase happened on March 10th. So we need to first sell these items purchased on March 1st and then use this actually 20,000 items purchased on March 10th because we are using FIFO inventory method. So there's a summary here of the price of each unit purchased on March 1st and 10th, and the number of units and the total actually the current inventory remaining per purchase. So it is important to use it for next transactions, which is here. The company sold 30,000 units on count for 15 each. Okay, this 15 is used for calculating our revenue. We don't need it right now. For calculating the cost of goods sold, uh, we need actually the numbers here. So we sold 30,000 items. Okay, we need to first use items bought on March 1st. So we can actually provide 15,000 items from that, actually 30,000 items from March 1st, and the remaining 15 items can be used from our purchase on March 10th. What is remaining is 5,000 items because we use this 15,000 items here and another 15,000 from our second purchase to provide our sale of 30,000 items. So we can calculate our actually cost of goods sold by, I can write it here for your actually better understanding. So 10 multiplied by 15,000 makes it 150,000 actually for inventory, and another 15,000 come from our second purchase. So 15,000 multiplied by 11 is 165,000 plus 150,000 makes it $315,000, which shows the cost of goods sold of our sale. So here you can see that the inventory sold of $315,000 comes from our calculation. The remaining inventory is 5,000 units, and each of them has a value of $11. So we update our inventory because we sold this $15,000 and another 15,000 units, sorry, units is the number of units. What is remaining is 5,000 units after our first sale. So our journal entries for selling that 30,000 units on account for 15 each is that because our sale was on account, our accounts receivable goes up for actually 30,000 multiplied by 15 dollars, and our sales revenue goes up by that amount. But because we have 2% return rate, we need to actually consider 98% of our actually our sale as our sales revenue, and the other and the remaining amount, which is 2% of Our revenue is sales refund payable, which is our payable, so it is a liability. It is on the credit side. So again, for your better understanding, we sold 30,000 units on account for 15 each. So this 15 each is used for calculating our revenue. So 15 multiplied by 30,000 units is $450,000. We have a rule here, 2% of our revenue is our estimation of return. So it's like we owe this amount to our customers who return their purchase. So this 2% must be actually considered as a liability to customers, and the remaining amount, which is 98% of that sale, is our sales revenue. And you know that revenue goes up, we need to credit it. On the other side, we need to calculate our actually decrease in our inventory. Because we sold items from our inventory, that cost of inventory we calculated using the price of each item and the number of each item, which was $315,000, is used here. That amount actually decreased our inventory. So our inventory is credited. Inventory is an asset, and when it decreases, you need to credit it. The cost of goods sold uh, is an expense. So when it increases, you need to debit. Why it is not equal to $315,000? It is because of rate of return. So estimated inventory return is 6,300. Why we debit it? Because we estimate they return some amount of our inventory, and if our inventory goes up for this amount for $6,300. So we debited. So the cost of goods sold is $308,700. So the total actually journal entries for transaction 3 is here. We used the price of items sold, which is actually the same for all items, to calculate our revenue, but those different numbers, you can see it here, are used to calculate cost of goods sold. Why? Because you purchase some amount, actually some units with a value, for example, here for $10 and $11, but you don't sell it at the same price. You want to make a profit. So you increase your selling actually price to $15 to make a profit. And you know that difference between revenue and cost of goods sold is your profit. Okay, let's work on transaction number 4. You purchased 15,000 units on account for 12 each. Okay, it is a repetitive journal entries. Your inventory goes up for the value of 15,000 units multiplied by 12, which is $180,000. And because your purchase was on account, you need to credit your accounts payable. You update your current inventory. You purchased 15,000 items for 12. So now you have 5,000 items here and another 15,000 items, which is your latest, actually your recent purchase on March 15th. So if you had any sale after transaction number 4, you need to first use this 5,000 items and then go for this 15,000 items purchased on March 15th. In transaction 4, you paid for the purchase made on March 1. So the value of your purchase was $115,000. So because you paid in cash, your cash goes down, you credit it, and your accounts payable decreases, you debited. In transaction number 6, you collected $250,000 from customers on account. Because you collected cash for your sale, your cash goes up and your accounts receivable goes down. Transaction number 7, another sale on account for 10,000 items for 18 each. This 18 is used to calculate revenue, okay? And these numbers here, 11 and 12, are calculate to actually are used to calculate our cost of goods sold and the value of our inventory, which is decreased. So we want to make a sale of 10,000 units. So we first use the 5,000 units of our purchase from March 10th because it was the remaining number of items, and another 5,000 items come from our purchase on March 15th. So your cost of goods sold of this actually sale is calculated using these numbers. So first, 5,000 items multiplied by 11. So from here, and another 5,000 is here. So 5,000 multiplied by 12. So you have two calculations. And the actually total amount shows the cost of goods sold for your sale on March 30. Your actually the number of units remained in your inventory is 10,000 units because you use this 5,000 here and another 5,000 from your actually sale, and the remaining number of units is 10,000 items, which has a cost of 12, which has a price per unit of $12. So the remaining actually inventory is 12 multiplied by 10,000 items. And you can see the ending results here. So the total amount of actually cost of goods sold is 11 multiplied by 5,000 units plus 12 multiplied by 5,000 units of your purchase on March 15th. So your total cost of goods sold is $115,000 for your sale on March 30th. Okay, you actually now you sold 10,000 items for 18 each. So your accounts receivable is $180,000 and your sales revenue must be equal to. But because we expect 2% rate of return, we don't consider it. So we just consider 98% of our sale as our revenue, and the rest is our sales refund payable, which is a liability to our customers. We expect it. And we can update our actually journal entries after being sure about our rate of return. So for our sale, we need to calculate cost of goods sold. So our inventory goes down by $115,000 and our cost of goods sold is actually 98% of our decrease in inventory because we expect 2% of our sale will be or would be returned in the future. So we calculate it as an amount which might increase our inventory. So we debit it. The customer return in our transaction number 8, customer returned 3,000 worth of goods, cost is 900. So our accounts payable goes down by $3,000 and our cash also goes down by $3,000. Why? Because our customer returned and that's actually return payable went down. So our accounts payable decreases. And because we paid cash, our cash goes down also. They returned some amount of actually our inventory. So our inventory goes up and our estimated inventory returns goes down because we it is not an estimation anymore and our inventory went up for real. In transaction number 9, incurred on account $45,000 in operating expenses. So operating expense is an expense. So our expense goes up, we debit it, and our accounts payable is $45,000. Our expense is on account, so we owe money to our providers or whoever they are. So here you can see the actually an overview of all journal entries we had, and we go for part B of the question. We need to calculate our sale, actually we need to prepare our income statement. For income statement, we calculated our revenue, actually we made for our two purchases, and we have cost of goods sold of those actually sales. So we can add them together. You can see it here. Our total revenue is five, actually $670,400, which is actually done in our sales on March 15th and 13th. And the cost of goods sold calculated is $421,400. It gives us our gross profit. We had an operating expense of $45,000. It is our income before tax. We know that we need to pay 40% as our income tax. So we can calculate 40% of your income before tax and it gives you your net income. In detail, you can compare the cost of goods sold written here to what you calculated in actually your sales on March 15th and 13th. And then you go down step by step. You know what's your sales revenue, you know cost of goods sold, gross profit, and then we know how much is our operating expense and we have income before tax. And then the question told us that the 40% of our income is for tax. So we calculate 40% of income before tax and it is our net income. Part 3 of the question asks you to determine the ending inventory value and show how it would be reported on the balance sheet on March 31st. So our ending inventory was actually is calculated after our sales. So these are actually our purchases and then our sales, and this $9,000 is our return. So the ending inventory is $120,900. So You can have a summary of your purchases and sales here. Positive numbers shows your purchases and negative numbers show your sales. So your purchases show increase in inventory and your sales show decrease in your inventory. And returns show increase in your inventory. So your ending inventory is here. And you can report it right here, right? Actually like this in your balance sheet. Remember, we had actually inventory as an asset and we reported in our balance sheet. And we actually add our estimated inventory returns. So we had estimated inventory returns of $6,300 plus $2,300 when we made actually sales to our customers and our actually one return happened. So it is not an estimation anymore. So we need to actually deduct it from our estimated inventory returns. Estimated inventory returns is another actually part of our assets. So we report it in our balance sheet. And in the actually fourth part of the question, we need to calculate gross profit percentage. Gross profit percentage is calculated by dividing gross profit by revenue. You know that your gross profit is calculated by revenue minus cost of goods sold, and you have your revenue also. Revenue minus cost of goods sold multiply by your revenue gives you your gross profit percentage, which is 31.7%. And here we need to calculate our inventory turnover ratio. Inventory turnover ratio is calculated by dividing cost of goods sold by inventory. When you actually do this using numbers you have inventory turnover ratio of 3.5. Don't forget, we have the ending amount of our inventory used in this actually formula. So it is 3.5. We are asked to compare it to industry average. So the industry average of gross profit is 30%, but for Franco Corporation, it is 31.7%. So it shows that a gross profit is higher than industry average, so the company is doing good. But inventory turnover of industry average is 5 times, and for Franco Corporation, it is 3.5. So it shows actually we had the corporation, the Franco Corporation, had actually more inventory on hand compared to the industry average, which is not good. We don't want to actually keep our inventory on hand. We want to sell it faster. In part 5 of the question, we are asked to assume that the ending inventory declined by $5,000. What value would the company report as inventory on the balance sheet? So if ending inventory declined by 5%, that means that the inventory balance we calculated will be 5% lower. So between the ending inventory you calculated by FIFO and the net realizable value, whichever is lower, you need to actually report that on your balance sheet. So you can see that the ending inventory calculated using FIFO here is $120,900. But from net realizable value, you can see that 115,900 is our inventory. So this amount is lower, so we need to actually journalize it and decrease the amount of inventory by 5,000 and increase our cost of goods sold by 5,000. Hope you actually got a good catch of this chapter. For your post seminar. You need to do actually question E526. This question has two parts, and you can work on your cost of goods sold of sale and rate of return, and you are actually working on your understanding of this chapter. That's the end of our actual session 5. Hope you have a good day and see you next week.